Today, we're digging into a critical question. Should investors be snapping up SoFi's stock after its recent dip? With the latest earnings release stirring mixed reactions, some investors are unsure if now's the time to buy in or steer clear. Stick around, and by the end of this video, you'll see exactly why SoFi's unique strategy and recent performance might signal a strong long-term opportunity for savvy investors. If you're here to make smart moves with your investments, hit that subscribe button. It's quick, it's free, and it helps the channel grow. SoFi released its quarterly results on October 29, 2024, leading to a 10% dip in stock price. This wasn't a huge surprise, given the stock's major run-up over the last few months. But before we talk about what caused this drop, let's unpack the main numbers, what they mean, and why this performance has left some investors concerned. The core financial services and tech platform segments, which are major components of SoFi's revenue model, hit a record high, now making up 49% of SoFi's adjusted net revenue. That's a big jump from last year's 39% and signals that SoFi is firmly moving away from traditional banking. Their strategy has been to reposition as a capital-light, high-return, tech-driven financial platform. This approach is comparable to how Tesla transformed from an electric vehicle company into a broader AI and tech leader. SoFi wants to follow a similar path, aiming for a tech-centric valuation that commands higher multiples. Traditional bank stocks often trade at lower valuations, while tech and financial platform companies can attract more enthusiastic investors and higher valuations. This pivot has been tangible, with revenue from these segments growing consistently. Next, let's break down the numbers in terms of revenue and profitability. SoFi's adjusted net revenue increased by 30% from last year, hitting $689 million for the quarter. This isn't small growth by any measure. Their adjusted EBITDA surged a whopping 90% to reach $186 million, a stark improvement from the $19.5 million loss reported in the same period last year. This sharp rise shows that SoFi's high ROI, fee-based business model is not just theoretical, it's actively boosting the company's financial stability and growth prospects. One particularly impressive aspect this quarter was the sale of over $1 billion in personal loans to third parties. Rather than holding these loans on its own balance sheet, SoFi offloaded them to other lenders, keeping the origin fees while avoiding default risks. And here's why this matters. By acting more as an originator than a lender, SoFi is capitalizing on the loan's profit potential without shouldering the risk of borrower defaults. And in today's economic environment, where risk management is more critical than ever, this approach makes a lot of sense. It keeps SoFi's balance sheet clean and positions it as a capital-light, profit-heavy operator. Now, let's focus on SoFi's overall loan portfolio performance and its exposure to credit risk. The numbers here tell a positive story. The on-balance sheet 90-day delinquency rate for personal loans dropped to 0.57%, down from 0.64% last quarter, and the annualized charge-off rate for personal loans decreased to 3.52% from 3.84%. These lower default rates are essential because they indicate SoFi's loans are performing well, especially in a period of economic uncertainty when many feared higher loan defaults. SoFi is showing resilience. Fewer defaults mean more of the revenue from their loan originations is actually reaching the bottom line. This decrease in delinquency rate also demonstrates that SoFi's underwriting standards remain solid, which is vital as the company continues to grow its lending business. When people consistently pay back their loans, it strengthens SoFi's reputation as a reliable lender and improves overall financial health. Heading into 2024, there were concerns about a potential recession and the impact it might have on SoFi's loan book. But now, with these numbers, it appears that the broader economy has held up well. Low unemployment rates, steady job growth, and declining inflation have collectively contributed to better than expected loan performance, providing a solid foundation for SoFi's future expansion in lending. However, there was one area where SoFi struggled this quarter: its home loan segment. With high interest rates, limited housing inventory, and inflated property prices, the US housing market is facing significant headwinds, and SoFi's home loan business reflects this. While home purchases and refinancing showed a 23% quarter-over-quarter increase and home equity loan volume grew 44% year-over-year, it's clear that the real estate market's current state has capped SoFi's potential growth in this segment. The high cost of homes relative to incomes and the pressure of elevated mortgage rates have kept many potential homebuyers on the sidelines. This slowdown means SoFi's home loan portfolio hasn't grown as fast as its personal loan segment. For now, this is an area to watch closely. While real estate isn't SoFi's primary growth engine, home loans are part of its diversified service offerings. Any sustained recovery in housing market activity, fueled by a potential decrease in interest rates or easing home prices, could become a future catalyst for SoFi's growth. With the stock price taking a 10% hit post-earnings, what should investors make of this decline? One reason for the drop could be the sell the news effect. Going into this earnings report, SoFi's stock price had already rallied over 50% in the past month, jumping from around $7 to $11. Investors had high expectations, and while the results were solid, they may not have met the lofty hopes of those looking for explosive growth across all segments. From a valuation perspective, SoFi's current forward price-to-earnings ratio stands at around 45. For those waiting to buy on a dip, this 10% pullback may offer a good opportunity. SoFi's tech-driven approach sets it apart from traditional financial institutions, and if the company keeps expanding its capital-light, high-margin business segments, the long-term outlook remains favorable. If you're still with us, you're here because you see the potential in understanding SoFi beyond the surface. We've covered a lot already, but we still need to dive into why SoFi's market strategy could make it a top contender in the fintech space. Stick around and we'll break down why their unique positioning in tech and financial services could keep them ahead of the competition. Looking at the broader economic picture, SoFi's positioning in a robust financial services and tech market is intriguing. The US economy, though impacted by inflationary pressures, has shown resilience, with steady job growth and rising consumer confidence. SoFi's financial strategy is aligned with these trends, aiming to capitalize on sectors where consumer demand is strong. Personal loans, for instance, continue to be popular, partly because they offer a more flexible credit solution for consumers who need funds for various personal expenses. In addition, the appetite for high-interest loans has increased among lenders, as the returns from these personal loans generally exceed what traditional fixed-income investments like bonds offer. SoFi is capitalizing on this demand by originating loans and selling them off to other financial institutions who are more willing to take on the risk of default. For SoFi, this means they are pocketing high-margin fees with minimal risk, a win-win situation that reflects the company's strategic insight into market trends. SoFi's strategic focus on becoming a financial services and tech platform rather than a traditional bank could have significant implications for its growth trajectory. Traditional banking models are tied to interest rate cycles, which impact net interest margins. In contrast, SoFi's fee-driven revenue model relies more on tech and less on loans held on their books. The company's goal to generate over half of its revenue from financial services and tech platform segments indicates its commitment to becoming a tech-centric platform. Before we get into the exciting details, let me introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up now using the link in the description and get those free stocks. Now, let's get back to the video. By focusing on high-return, capital-light segments, SoFi is effectively shielding itself from some of the volatility associated with interest rate fluctuations. This approach also aligns with investor demand for growth tech valuations rather than banking valuations, potentially driving higher multiples over time. So, here's the key takeaway. SoFi is no longer just another bank stock. It's a tech-driven financial platform with a unique model that minimizes risk while maximizing profit potential. The recent earnings dip might seem discouraging to some, but for those looking at SoFi as a long-term play, the dip could be a prime entry point. The company's strategic shift to high-margin, capital-light revenue streams paired with its focus on expanding in the tech sector sets it apart in the fintech industry. In a world where tech and finance are increasingly interconnected, SoFi's strategy may very well position it as one of the most promising companies in the sector. Of course, like with any investment, due diligence is key. So, if you believe in SoFi's potential, the current dip might just be the chance to get in before the stock rallies again. This is it for this video, guys. Thanks for watching and please make sure to subscribe, like and leave a comment down below.